Is the Kotak E-Invest Plus plan a smart digital investment for today's investor or just another ULIP with an online twist? Let us find out through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. So before analyzing this policy, let us first understand a few basic details about it. So this is a non-participating unit-linked life insurance individual savings product. Some of the key features of the policy are there are 3 plan options, each designed to cater to different financial goals of yours, and there is 100% premium allocation. So your entire premium goes into investment without any allocation charges, and starting from the end of the 6th policy year, yearly additions continue till maturity or death depending on the chosen plan, and between 25% to 200% of the life cover charges deducted or added back to your fund value. And also you get to choose from 2 flexible strategies to manage your investments, and you also get to enhance your coverage through optional riders. So these are some of the key features of the policy, and there are benefits like death benefit, maturity benefit, yearly additions, and return of mortality charges. So all these benefits will differ based on the plan option you have opted for, and there are also various charges that will be deducted from your premium before investing. So these charges associated with this policy can be a significant burden for investors. Unlike most market-linked investment options which typically allow free switching, withdrawals, or exits, ULIPs like this one often comes with multiple fees. Over time, these charges can erode your returns and negatively impact your long-term wealth building journey. So this is the biggest drawback. So you need to keep in your mind before deciding to invest in this policy. Now look at the advantages of this policy. So there are flexible maturity benefits. At maturity, policyholders can choose to receive the proceeds either as a lump sum or in pre-decided periodic installments through the settlement option. And partial withdrawals are available from the 6th policy year onwards, offering liquidity when needed. And you can also switch between fund options or modify your future premium allocation based on your investment strategy and changing goals. And you can do adjustments to your basic sum assured, premium payment term, policy term, which are all permitted, providing greater control over the policy. And there is triple protection in the unfortunate event of the parent's demise. And it also offers you regular retirement income along with an income booster to help manage post-retirement expenses effectively. So these are some of the advantages of this policy. However, the disadvantages are policyholders cannot avail loans against this policy at any stage. The policy does not offer any liquidity during the first 5 policy years, like surrender, partial withdrawal, or payout is not permitted. And the sum assured provided under this plan may fall short of offering sufficient financial protection for your family's basic needs, and compared to other market-linked investment options, the potential returns from this plan are relatively low, which may hinder long-term wealth creation. So these are some of the disadvantages of this policy that you need to keep in your mind before deciding to invest in it. So if you want to know more about certain aspects of this policy in detail, you can definitely refer the policy brochure. So now, as we have a basic understanding about this policy, let us move on to the analysis part of the video, where we are going to conduct an IRR analysis by calculating the internal rate of return of this policy based on the benefit illustration given in the policy brochure to help us make more informed decision. So here let us assume for calculation purpose that a 35-year-old male has opted to invest in this policy in the wealth creation variant with the maximizer. So with a sum assured of 5 lakhs. So the policy term is 20 years and the premium paying term is 7 years. So the annualized premium is for 50,000 rupees. Since the policy is focused on wealth creation, the maturity benefit will be payable at the end of the 20-year term. So here, based on the assumed returns of 4% and 8% per annum given in the brochure, just to project how the outcome of a worst case scenario and a best case scenario can differ. As an example, let us see what the returns have been. So at 4% return, the fund value is 5.35 lakhs with an IRR of 2.53% as per the policy's maturity calculator. At 8% return, the fund value is 10.06 lakhs with an IRR of 6.36% as per the policy's maturity calculator. So these returns are just for example purpose. They do not seem to be guaranteed returns because they don't represent the only upper or lower limits of actual performance that you can get from this policy. This is just for example purpose. So these projected returns have been taken from the policy brochure. So as you can see, the IRR IRR here calculated seems to be modest and it falls short of the potential offered by other equity linked investments. As a result, this policy may not be a suitable option for those aiming for aggressive wealth accumulation through equity exposure. So these are some drawbacks that you need to keep in your mind before deciding to invest in this policy. So as this policy is not giving us a desirable outcome that we need, let us now move on to a comparative analysis where we are going to explore an alternative strategy in which we will invest insurance and investments separately just to see whether it will be efficient. So here for a life cover purpose, we have opted for a pure term policy with a sum assured of 5 lakhs which cost us just 10,000 rupees annual premium for a 20-year term with a 5-year premium payment term. We have taken similar metrics from the Kotak e-Invest Plus policy for a fair comparison. But in contrast, the same policy will require an annual premium of 50,000 rupees in the Kotak policy. By choosing term insurance, we are able to save 40,000 rupees per year, which can be strategically invested based on a risk appetite. So instead of using a bundled ULIP, the saved 40,000 can be invested in either a low risk product like PPF or a market linked product like an equity mutual fund. So in this analysis, we have opted for an equity mutual fund as it also has some risk just to see whether it can give us better risk adjusted return for a more fair comparison. So the maturity value from equity mutual fund is 20.75 lakhs, which is the pre-tax value. After capital gains tax, the post-tax value is 18.69 lakhs. So the post-tax IRR is 10.24%. If you have any doubts regarding how we have calculated the tax aspect of this equity mutual fund, we do have a small tabular column presented on the screen for your easy reference which you can pause and see. So this approach not only ensures adequate life cover through term insurance but also generates significantly higher returns compared to Kotak e-Invest Plus plan. So separating your investment and insurance needs provide greater flexibility, transparency, and the potential for higher inflation adjusted returns. So as this comparison shows, combining a pure term plan with a targeted investment strategy is far more efficient than opting for bundled products like ULIP. So what is the final verdict then? Is investing in the Kotak e-Invest Plus plan worth it or not? So this policy gives you the flexibility to invest in market linked funds and tailor your maturity proceeds based on your financial goals. However, beyond these features, it remains a typical ULIP where neither the insurance cover nor the investment performance truly benefits the policyholder. A closer look at the projected returns reveals that it is a low yield product with an insufficient sum assured, offering limited protection to your family. As a result, this policy is unlikely to help you meet your long-term financial objectives and may hinder your overall investment journey as it also has a high agent commission. So to build wealth effectively and secure your loved ones, it is advisable to avoid bundling insurance and investment. Instead, consider purchasing a pure term life insurance policy for comprehensive protection and investing separately in products aligned with your goals and risk appetite. So this approach offers better returns, more liquidity, and greater control over your finances than ULIPs like Kotak e-Invest Plus plan.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.